from the rooftop of the Hermann London Real Estate Group in beautiful downtown Maplewood. It's the St. Louis Realtor Podcast with your host, Adam Kruse.
All right, well, welcome to the Hermann London Real Estate Group podcast. This is podcast number 4, I believe. This week's agenda, we're going to go through here real quick. We're going to have some updates. I'm going to ask John, Charlton, everyone's favorite lender, a few questions. We're going to have one of our agents, Harley, from Team Coleman in here, and he's going to tell us about his deal of the week. I'm going to go through some of the questions that people have asked, and then finally we'll have a conclusion. Maybe we'll make it a quick week. It's the holidays here. So first of all, I'm going to go through some updates. We have our business planning retreat coming up. It's on November 21st. It's an all-day company event. Most of our realtors are going to make it. And I want to just say, even if you are not a realtor, now is really a good time for you to start planning out your business for the next year. You know, take time to reflect, think about what you want to do, where do you want your business to be, what do you want your finances to be, how do you want your life to look, all that kind of stuff. This is a good time of the year to be doing that. And also for our business planning retreat, I've been working on making some career guides for the different realtor paths. You know, we have a lot of realtors here at our company, and almost every single one of them has their own path. And based on how they want their life to look and feel and how much money they want to make and that type of thing. So I'm breaking down a few of those paths and giving some people some ideas on where they can go and maybe their path to growth or their path to become a broker or their path to own a Hermann London office. I'm also going to unveil this case study I've been working on for quite some time, actually. It's a case study of a top producing agent, sells more than $10 million of real estate in a year, every single year, and I'm breaking down a case study of that person, and I'm going to share it with our agents too. So I'm excited for that, for our business planning retreat. I know Trey has been preparing a lot of stuff too. And so if you're a realtor and you're considering joining Hermann London, now's the time, so you can make it in time for our retreat, which is in 10 days. The only other update I really wanted to go over is that there's still low inventory. We have a Facebook group there's something like 500 realtors on there, and we're always posting on there new listings, coming soons, and buyer needs. You know, and every single day these agents are posting on here, buyer need, 3-bed, 2-bath, Webster, buyer need, 1-bed, this, that, you know, Oakville, whatever. These realtors have these buyers out there that are looking for properties. They can't find them. They say, we've seen everything on the MLS. We don't like it. We're looking for something else. And so there is low inventory. There are buyers out there. This, for me and for some of our agents, is one of the busiest times of the year. So if you're considering selling your home, I encourage you not to just wait till spring like everybody else and be one of the 25 other homes in your subdivision that are putting their home on the market. Get it on the market now. You'll have less just random people tromping through your house, and you'll have more serious buyers. So give us a call, 314-802-0797. Let's get your home listed. We can have it sold by the holidays. All right. Well, we just had Harley in here. So next up, I'm going to go through the questions that people have asked, and I'm just going to kind of go through the question and try to give the answer. So we had Nancy, a shout out to Nancy. She asked me about 2 homes that are for sale on Geyer. She lives on Geyer, and there's one home being built at 1306 North Geyer. And believe it or not, it's listed already, and it's listed for $399, and it's about 2,400 square feet or so. And there's another rehab that they've been watching. I know you've been watching a few homes up the street from you, and it's sold for $132,000 prior to the rehab. That might seem like a low number for that area, but I know they've put so much work into that house. I think they might have added another story, added a garage, finished the foundation, or refinished the foundation, all that kind of stuff. So how much is the house on Geyer? How about that? I gave you 2 for the price of 1. What is the Cashflow board game, and how does it relate to real estate? Some people, I guess, have seen my posts on Facebook. I'm always talking about how we're playing this Cashflow board game and why do we play it and what the heck does it have to do with anything in the first place. Basically, the Cashflow board game was a board game that was made by Robert Kiyosaki, who, if you don't know who that is, you've probably read his book, Rich Dad, Poor Dad, or at least you've heard of it. And Robert Kiyosaki made this board game to basically get across the point of how different people see money, deal with money, treat money, and how they get out of what he calls the rat race. And basically, if you can get out of the rat race, you can win this board game. And the whole point is, some people start out as a doctor, some people start out as a janitor, some people start out as a nurse in the game, but you have you literally have spreadsheets, and you need to bring a calculator and a pencil to play this game. And so you might find it interesting that the doctor, although they might have tons of income, basically often, or at least in this game, they also have tons of expenses. The best example I can give is if the doctor has a car, they probably buy a Mercedes, and their payment's $500 a month instead of buying a Camry or whatever and having a $200 a month payment. If they're buying their son a shirt, they're probably buying a polo shirt instead of buying a shirt from Walmart or whatever. So even the doctor has to keep working and working and working and working and working and working and living for that next paycheck. So the point of the game and how it relates to real estate is it really points out and shows that if you buy real estate, you can make passive income, and the more passive income you can make, if you can make enough passive income to cover your expenses, then you are out of the rat race and you can live on your passive income. You can keep working if you want to, but you don't have to. You can go on vacation if you want to. You can go visit your family or do whatever you want to do. You're no longer tied to having this job to make your next paycheck, to make your next payment or whatever. So the game gives you opportunities to, buy a 3-bed, 2-bath house that's going to cash flow $400 a month or whatever type of thing. And so you can try to buy that real estate or not. And it's interesting to watch different people play it and the decisions that they make, and kind of makes for some interesting conversations on how to invest and how to, how different people like to invest and how they like to make money. And for me, my big goal is having enough passive income to get out of the rat race so I can sit here and do these podcasts for fun and, have my rental investment real estate making enough money to pay all my bills. So next question. Why doesn't reducing the sales price by $5,000 help the buyer like it helps the seller? I need granite. I think the point of this question is, and I'll sort of point out that I guess a lot of times when we're working with a buyer, we're looking at a house and they say, we want to update this house. For example, we need granite, or we want new counters, or we want to add ceiling fans to every bedroom, or we need to redo the deck or whatever. And let's say the home's listed at $350,000. Why doesn't reducing the price to $345,000? Hey, now that's $5,000 less. We can use that money for the granite. Well, no, you can't, because you're not getting that $5,000. The lender's not going to say, "Hey, here's a loan for the $350,000 and you just get to keep the $5,000." Your new loan will be for the $345,000. So basically, by reducing the sales price by $5,000, you're effectively just lowering your monthly burden by, let's just say $33 or so, something along those lines. Talk to your lender, call John Charlton, for the exact numbers. But basically, when the buyer is buying a property, reducing the price helps lower their monthly payment, but does not put any money into their pocket to do any updates they need to make. If it's a small amount of money they need for updates, we can talk about getting closing costs covered. Or if it's a large amount of updates, then listen to our podcast that we talked about getting the FHA 203K loan, where you can get $10,000, $20,000, $30,000 to, put in all new granite, update the bathrooms, put on a new deck, all that kind of thing. But reducing the sales price by $5,000 or raising the sales price by $5,000, I guess I could say, does help the seller directly, because that is money that will directly go into their pocket at the closing. Let's say they owe $300,000 on the house. If it sells for $305,000, they're literally going to get a check for $5,000. All other kind of variables and costs or whatever, being ignored in this situation. But basically, or assuming they have no loan or whatever, but if we raise the sales price, that money does grow directly to the seller. And in a lot of cases, it's interesting to me that when we're doing these real estate deals, the buyer will say, like, "Oh, it's only $1,000. Oh, it's only $2,000." And it's funny to see the same person who, doesn't upsize their fries at McDonald's or whatever because it's an extra dollar, will kind of put this, "Oh, it's only $1,000" perspective onto things. And when you're buying a house, I guess it is only $1,000, or in effect, it is only a couple dollars a month on your monthly payment. When you're selling a house, that only $1,000 is literally $1,000. You can get $1,000 more when you sell your house that you can use to put as a down payment on your next property, or buy granite on your next house, or upsize your fries for the next year and a half, or whatever you want to do. So that's why reducing the sales price doesn't necessarily directly help the buyer to rehab the property, but it does help the seller. Why is December not a bad month for real estate? I talk a lot to people that say they want to put their home on the market and they're going to wait till the spring, or the buyers who might want to wait till the spring to buy. Basically, there's a few things that are happening at the end of the year. The buyers that are out there are serious buyers. If they're going to be, I talked about this a little bit already, but if you're going to be looking at properties a couple days before the holidays, trudging through the snow, like I've literally shown homes where every single house we had to get out of the car, step into a foot of, virgin snow and get it all in our shoes to get into the house. These are serious buyers. Anyone would rather be at home drinking hot chocolate, but instead we're out looking for homes. This is a serious buyer. Another thing, if you're going to buy a home that's a builder's home or maybe an inventory home of a builder, they want to sell their homes by the end of the year. Why? Just because they like to get it off their books, essentially. In general, there's less competition in the wintertime. There's in theory less homes that are for sale, and for certain there's less buyers that are out there looking at real estate. But the buyers that are out there are serious. In the summertime, you get a lot of the people who just kind of I just like looking at houses. I just think it's really neat. I see a lot of those people who are just kind of nosy or whatever. They want to see what's going on. Okay, seller, this is a seller's question, and if you have your home listed, you might be wondering, how can I reset my CDOM or my DOM? Or in this case, you might be wondering, what the heck is CDOM or DOM? Basically, if you're searching for real estate on certain websites, you might see something that says DOM or CDOM, and that stands for days on market or concurrent days on market. And basically, if you have your home listed, at least in St. Louis, on Maris, if you have your home listed with a realtor and you want the days on market to go back down, let's say they're getting up there, they're over 150 days or so, you actually have to take your home off the market for 60 days. So, if you take it off 61 days from now, the listing literally has to be in canceled status. Then it will restart it at 1. Now, if you have your listing with one realtor, let's say you're at 100 days on market at this point, you take it off the market for 2 weeks, and you list it with me, and I put your house on the market right then. The days on the CDOM are going to start at 114 days because that's concurrent days on the market without being off the market for 60 days. So, long answer to a question we actually get a lot. It's one of the most visited pages on our website is people Googling for how they can reset their CDOM or what is CDOM. So that's what it is, days on market. How long has this home been available for sale? And basically why does it matter is because once a home's been listed for 100 days, 150 days or whatever, a lot of buyers are wondering what's wrong with this house. And that's one of the problems that we see with people who list their home for too high of a price. You get a lot of buyers in there. A lot of buyers are coming through. They're not buying it. Next thing you know, our days on market's at 150. Someone comes through and they're interested, but they're skeptical. They're wondering what's wrong with this house. Why has no one bought it? What should I be concerned of? And that might scare them away. All right, up next, we're going to bring in Harley Coleman with the team. Coleman recently joined the Hermann London Real Estate Group, our South County experts. We're going to bring Harley in to talk about the deal of the week, and I'm going to hit him with a couple questions as well. Here comes Harley. All right, guys, up next, we've got Harley Coleman with Team Coleman here at the Hermann London Real Estate Group, and Harley is going to tell us about the deal of the week. Harley, you have a listing, right?
Yes.
And it's a hot deal?
Hot deal.
Tell me all about it.
Back on the market. It fell through due to buyer financing.
Buyer couldn't get a loan.
Buyer couldn't get a loan, yeah.
Womp womp.
Yeah, so...
What, they couldn't get a loan, or didn't they have to sell their house and they couldn't get their house sold or something?
Well, yeah, but that was part of the contingency. They had a contingency on their home. They had to sell theirs before they could buy ours.
Okay, but I just want to make sure there's nothing weird about this house that makes it non-loan worthy.
Oh, God, no. No, ours passed county inspection already, gas inspection.
It's already passed its inspections?
Yeah.
Where is it?
Oakville area, right off Christopher Drive. It's off the house is actually on 136 Christopher Place.
Okay. How much is it?
Listed right now at $339,900.
That's one of the things I love about real estate deals is a lot of people think of deals or investors or whatever buying these $15,000 houses. They don't have to. This isn't necessarily an investor house, is it, or is it?
Oh God, no. It's
not.
move-in ready. It's only 12 years old. It's a beautiful home.
Why do you say, "Oh God, no"? You don't think an investor could buy it and rent it out and make money? You're just not
typically that's
that.
not what they're looking for. Yeah.
Okay, you're just not picturing an investor wanting to do that.
No, not at all. Usually they want something a little more like a foreclosure of some sort or a bank-owned HUD home or something like that. Then they usually.
Harley, are you telling me I have to buy a foreclosure to get a good deal on a piece of real estate?
Gosh, no. This is great.
Okay, so how's this house's condition? Is it good?
Beautiful condition.
Move-in ready?
Move-in ready. She meticulously kept up on the home. It's in great shape.
Okay, so it's $339. How large is it?
3,100 square feet and that doesn't include the finished basement.
Oh, finished basement.
Yeah.
Okay. Can I put a pool table down there?
Yes. It has a big ping pong table right now, but yeah, a pool table would work.
We'll have to put that in the trash. Would you move that? If I buy this house, would you be willing to get the ping pong table out of there for me?
I would throw it on my back and move it out there personally.
Okay, how many bedrooms and bathrooms?
6 bed, 3.5 bath.
All right, talking to you a little bit ahead of time before we had our podcast here in our green room, you told me you had a few listings coming. Can you give me an update on any hot listings coming we need to know about?
I've got about 5 potential upcoming. Well, 4 I know for pretty much for sure. The other one we have a listing appointment next week for.
Okay. So I don't need addresses, I guess. Just give me the gist, where they are, price ranges, that kind of thing.
Sure, yeah. I got one 3-bed, 1.5 bath, and 1,400 square feet, 2-story. The new Cherokee district that's kind of up and coming.
Yeah, absolutely. Kind of hipsters might be able to live there.
That's going to be going on the market probably within the next month or two, right around the 100,000 mark.
Okay.
We also have a 2-bed, 2-bath in the next month or two as well, in the St. Louis Hills, Carondelet Park area.
Popular area these days.
Yes, and that one will probably be listed for about 130 to 140-ish.
Have you been there yet?
Yes.
Is it updated or does it need work?
No, it's pretty well updated, yes.
Okay. Mm-hmm. Okay, what else do you have coming up?
We have a 3-bedroom, 1.5 bath, another 1.5 bath, 2-story in South County. I sold to them last year. Their family has grown considerably, so their situation has changed, and they need a bigger house.
Okay.
And so we're going to be selling that. They have to get it ready. They put an addition on.
Oh, wow.
And they're in the middle of that right now. So as soon as they get that done, we're going to put it on the market. So.
Well, I like that. You are our South County expert, so I'm glad to see you coming at me with some South County.
Yeah.
A little bit of South City, but
yeah,
South
a little
County
South
generally
City,
properties.
South County.
Okay, what else you got?
We have, you can't, I don't know if you consider Arnold South County or not.
I sure do.
I kind of do. It's right there on the border there. We have a 3-bedroom. Now, this is the listing appointment we have next week. It's a 3-bed, 2-bath, 1,500 square feet. I don't know all the specifics yet, but my guess is we'd be priced around 150 to 160.
So we should wait before we send our full price, all cash, as is offers directly to you?
Exactly.
Wait a little bit. Okay, we'll wait on that.
And we have one more. It's actually way out of our area, but I sold to this investor earlier this year, and she's flipping this house. Well, she got it really, really, really cheap. And originally she was going to fix it up and rent it out. Now she's just going to flip it and sell it and try to break even on it.
So you helped her get a good buy on it? Yeah,
I did. And then it's a 2-bedroom, 1-bath, 1,100 square feet. For a 2-bedroom is pretty good. But it'd be a good rental property. It's up in North County.
Why would she bought it so well, why does she need to barely break even on it?
I would say she put too many updates.
Over-fixed it?
Over-updated it for the area, what things are selling for.
Okay.
Yeah.
Okay. So, any other properties you want to tell us about coming up?
As far as listings, that's all I have. I got a lot of buyers coming up here, about a half a dozen buyers.
So if you have a home to sell,
people are buying.
Call you.
Definitely.
Where are your buyers? All over? Just South County? Where are they?
Our buyers are in South County, Jefferson County, maybe one in St. Charles. I do have buyers from, all over the place.
Okay.
Yeah, because we have a pretty big database of people. So,
okay. So what have you and your wife, Jessica, let's give a shout out to Jessica here. I'm sure she'll be listening.
Hi, honey.
What have you guys been working on? I see you coming in and out of the office. We just mailed all those postcards out. You got all these listings coming up.
Yep.
What else have you guys been doing?
Well, a lot of prospecting with former clients, people that we've worked with before.
Keeping in touch with your past clients.
Okay. Yeah. Like if there's been like a 1-year anniversary on a sale, we give them a call and wish them a happy anniversary and ask them how things are going. And we always tell them to, keep us in mind if they know anybody. And we're also doing a lot more networking now, going to networking events and spending a lot of time, just shaking hands.
Well, you know how I'm going to want you to answer this question, but I'm going to ask it anyway. What do you see, like the market slowing down because it's the holidays or whatever, because it's the winter time?
Last winter, I sold the most amount of houses in December and January. Buyers do not slow down.
Okay. We
have the more serious buyers during that time.
Okay.
Because most people looking for real estate during those months are serious and they need to move.
That's what I wanted you to say, because that's kind of my exact situation. I've always had December be some of my biggest months, and
I sold 10 homes in December and January last year combined.
Wow.
Like 4 in December and 6 in January. So
I guess if you're out looking at real estate the day before Thanksgiving, or if you're out looking at real estate on a couple days before Christmas Eve or whatever, you're probably pretty serious, right?
I would say so, definitely.
And I hope so. If I'm going to take my time the day before Thanksgiving to be out showing you properties instead of making my green beans for Aunt Mary's Thanksgiving party.
Yeah.
Okay, so one last question. We had Trey on to our podcast a couple weeks ago, and I'm curious from you. I know I didn't tell you I was going to ask you this, but what has Trey done for your business, Team Coleman? How have you been affected by Trey?
Trey has given us a new vision, a new outlook on the way we should be handling people, treating people, and just getting out there. And I don't know, it's just not about sales, it's about people, and being
it used to be for you more about sales, more about it's kind of transactional.
People through the door, transactional, get them under contract, pass them off to the transaction coordinator. We get next. It would be like next,
And so he's taught you to make it more about relationships?
Really building relationships and really just treating people a lot better than our last broker, I don't want to bring this up too much, but, she was just like
more transactional.
Transactional, get them through and then pass them on and let's go to the next one,
I guess you can judge if you get invited to more holiday parties this year than last year. Let's say that you're doing something right. Mm-hmm. No, if you go to those parties, then you're really doing something right.
Well, we got invited to 3 Halloween parties.
Wow, okay. That's good.
Yeah.
That's good. That's from just being out there talking to people.
Exactly. Yeah. Mm-hmm.
All right. Anything else you want to tell us about Harley?
We're the best.
You're the best.
Team Coleman.
Team Coleman. Go get them.
Yeah.
South County experts. And you're sponsoring a poker tournament tonight, right? You got to get to that.
Yeah. I gotta go here in a few moments. So.
All right. Well, thanks for coming in, Harley, and we will see you on the flip side.
Thank you.
Take care.
Bye-bye.
Next up, we're going to bring in John Charlton, our favorite lender, and I've got a couple questions I want to ask him, put him on the spot a little bit, see if I can make him squirm. And so let me go get John and bring him on in. All right, everybody, up next, we've got Mr. John Charlton, everyone's favorite local lender from Midwest Mortgage Capital. Came all the way from the office right next door to mine. Hi, John.
Long walk.
Long walk. You could hear me call your name, couldn't you?
I could.
All right, Mr. John, this week I've got a couple questions for you. I'm
Q&A,
hoping to make you squirm.
Okay, squirm. Let's see.
I'm guessing I won't, because you always have the answers to everything, but tell me this. What is the difference between you and a credit union? And if you really want to get in depth, what is the difference between you and a bank and a credit union? Well, let's start with what's the difference between you and a credit union.
So let's just maybe within that give you a definition of what we are. So we're what's called a correspondent bank. What that basically means is that we underwrite, fund, loans that we ultimately are going to be selling the servicing rights to nationwide providers like Chase, Wells Fargo, U.S. Bank, etc. The key differentiation between a correspondent bank and a regular bank is that typically banks will pay money for somebody else to do the underwriting, processing, all the hard work, and then all they have to do is service the loan, and that's really easy for them.
Okay.
So that is usually a way in which we will price better because we don't have the overhead that the bank has with a loan. Same thing goes with the credit union. Credit unions typically are going to price a little worse than us as far as interest rate goes because they are funding, doing all the loan, all the work themselves. They're not just buying the servicing rights of the loan.
What about the credit unions that say they're not for profit? What does that even mean?
Well, it means that they're not, I could say not for profit, but that would be kind of.
Oh, that clears it up.
Yeah,
Thank you so much.
no problem.
I appreciate that.
It's the soup du jour, which is the soup of the day.
Do they are they not making any money? What are they doing?
What that means is that they don't have shareholders that are earning money from the business. So usually a non-for-profit credit union is going to be a credit union that's owned by all the people who put money into the depository. They're not looking to pull a profit for investors on the loans and the work that they do. That's what it would be to be non-for-profit.
Just enough to pay interest on those like checking accounts.
Just enough to basically make it viable, keep the lights on. I mean, usually they are very profitable, in the sense that, ultimately they have lots of reserves that they aren't paying out to shareholders, they're holding on to. So,
do you guys ever sell your loans to credit unions?
We don't. I mean, there are some exceptions, like certain loan products that we're unable to do. This is going to be stuff that's, short-term balloons, land loans, things like that a credit union may be able to do that we wouldn't. So we would partner with a credit union, but we wouldn't necessarily do the loan.
And then does the credit union always service their own loans, or are they selling to Chase too, or whatever sometimes?
Yeah, so good question. Some credit unions do 100% shelf loans, meaning that they don't sell the paper, they don't sell the debt on the loan at all.
Okay.
Most credit unions nowadays are hybrids, so they'll do some Fannie, Freddie. They'll never do FHA paper, no government loans, USDA, but they will do loans that they could sell if they needed to make the credit union solvent, if they needed to.
You said shelf loan. Is that the same as portfolio loan?
Absolutely. Yeah. Shelving the loan just means that you're actually giving somebody money to do something. You're holding that debt. That's on your bottom line. If you sell the debt, then obviously somebody else is paying the amount of the debt so that they're solvent.
Okay, so if I'm working with a buyer, they're pre-approved from a credit union, I shouldn't think to myself, oh, credit union, they got the best deal in town. Like, don't even bother having them call John. No. I mean, a credit union is a great place to go if you can't get a correspondent loan. If you can't get a loan, Fannie, Freddie, if it's a one-off, if it's a self-employed borrower, relationships are what's good about credit unions. They might have a long relationship with somebody. That's going to maybe play a role in their ability to get financing. But in general, if it's a person that could qualify for a loan with a correspondent bank, they're going to get a better deal, lower interest rate, lower closing costs than they're going to get from a credit union. Okay, so one of my clients that I'm working with now was pre-approved with the credit union, and I just had him talk to you today. Mm-hmm. Do you have any information about, definitely don't want to give client information out at all, but I'm wondering, do you know what the rate they were getting there and how that compares to the rate you're getting, or their fees or any of that kind of stuff? I don't know all the details of the quote that they got from the credit union, but in general, I know what I'm matched up against when I have somebody who's working with a credit union. Like I said, the main thing with a credit union is that they're very stringent. They have a loan that they offer. They're going to offer to all their members, based on some criterion, credit score, debt to income, what have you. But they're not going to be able to, to vary from whatever their pricing is. They are what they are. You know what I mean? Whereas we have a lot more flexibility with the loan, the type of loan, the terms of the loan, and what have you. They're going to be pretty much straight up. So in the case of the person you're talking about, my hunch is their interest rate's going to be higher with the credit union, and I think that was absolutely the case. Higher interest rate, lower fees up front, or what? Typically, no. Actually, typically the fees are going to be about the same.
So why would somebody ever use a credit union? Because there are loans that can't be done Fannie or Freddie. There are a lot of them.
So for someone who needs a loan that's basically going to become a portfolio loan, maybe that's a good place to turn to.
Absolutely. And the best way to know that is if you apply for a loan with me and I can't do it, well, I know people that can, as far as credit unions and what have you, that I could refer you to.
I mean, if I call you and I need a loan and you can't do it, you're not going to just tell me that I can't get a loan. You're going to say,
no,
hey.
I'm gonna do whatever I can to make sure that you exhaust every possibility if it's something you want to do.
What a sweet guy. Okay. Well, next question, Mr. John. I pulled up a website and I saw a huge, flashing ad. I think it might have had a monkey moving back and forth on it. And it said I can get basically a free set of steak knives and a low interest rate. And it was like basically a web-only company, and I'm just kind of curious, how are these people, are they tricking me, or how are they going to trick me and not, basically I'm assuming that they're trying to trick me and it's not going to end up being this great deal that they're talking about.
Yeah, no, I mean, I'm on the internet as well, every day, and I see banner ads all the time offering interest rates in the 2s, et cetera. I mean, I guess a great example of that is there's a
it's not January. What are they thinking?
That's right. There's a ad on the radio right now where somebody's basically advertising a 2.875% interest rate, but then you wait to the very end and they say, that it's a 15-year FHA loan, with an APR up over 4%. So what are they really selling you? They're selling you the idea of a really low interest rate when in all reality they're gouging you in cost.
So you have to bring a bunch of money up front?
Yeah, or you have to finance that cost that they're building into the loan. So, I mean, they want to trigger your response by saying something in the 2s, right? 2.875. But when you get to the APR and it's 4.04, well, really, it's not that great a deal.
Okay. Well, that kind of makes me want to ask you this, and I've always sort of told buyers, hey, if we want to compare apples to apples, a buyer's always like, well, I'm talking to this guy and this guy and this guy, right? I'm talking to this bank and this lady and this whatever. And I was always thinking, hey, you want to compare apples to apples, get a good faith estimate from each one of them.
Good faith estimate is a great tool for that. I would say that there's an even better tool within the RESPA package. It's called the TIL, or the Truth in Lending document. It's going to make it dumb it down the good faith, because there's lots of lines in the good faith. There's lots of costs there. What a TIL says is it says what your APR is.
The APR is the apple to compare? That's
correct, because if you have two banks that are offering you a 3.5%, and one of them's their APR is a 4%, and one of them's a 4.5%, the bank that's giving you less closing costs is the 4% APR. So APR is is a way that the government has decided is a good way, simple way for people to compare quotes. And that's all it really is meant to be. It's not the effective interest of the loan you're doing. It's just expressing the cost of the loan as a percentage so that you can compare easily. Okay.
Now, the only thing that I guess I don't like about any of these solutions is that, let's say I'm talking to you and you quote my buyer that their appraisal, or not even appraisal, let's say their homeowner's insurance is going to be $800 a month, and then they call someone from this internet and they just put a number in there of $300.
Okay, so there is a difference between APR fees and non-APR fees for that exact reason. Non-APR fees would include things that are like homeowners insurance, taxes, that somebody could grossly underestimate, but it's not affecting the APR.
We can still look at the APR, or are you saying there's something we need to look at called non-APR fees?
No, there's not. You don't even have to look at the non-APR fees, because what you owe for taxes is what you owe. What your insurance costs is what your insurance costs.
Oh, those fees are not included in the APR.
Correct.
Okay,
they're non-APR fees.
So we could look at the APR.
So what a bank is held to is if they give you a quote with a TIL, Truth in Lending document, and basically they're quoting in that, the APR fees would include any bank costs, any processing costs, appraisal fees are included in that, how much the appraisal would be. Also title fees, which is a key one because a lot of times people really, in years past used to really misquote what a title cost would be and then surprise a borrower with the actual cost.
And I'm sorry, I didn't have any control over it.
Right. So that's true. You didn't have any control over it. But at this point, the way that banks produce truth in lending documents, they're held to what they're actually quoting for those costs, which are APR fees.
You're one smart cookie.
Sometimes.
All right. Thank you, Mr. Charlton. Please, if anyone has any questions, submit them. Submit them through our Facebook. Submit them through podcast@hermanlondon.com. If they have any direct questions for Mr. John Charlton, give him a call. Here's his number.
314-744-7851.
And you always smile when I ask this.
NMLS number 188910.
There's that smile. All right. Thanks, John, and we'll see you in a couple weeks.
All right. Thank you.
All right, guys, thanks for listening to our podcast again, and this is podcast 4. I think it went pretty well. Joey Vosevich is in this studio here on the Hermann London Real Estate Group roof. It's getting a little cold out here, Joey, and, I just want to encourage everyone to go to as many holiday parties as you possibly can. Everyone wants to see you. Everyone would love to have you there, and if anyone has a wood splitter, let me know. I need to borrow a wood splitter. Thanks again for listening, and we'll see you in a couple weeks. Take care.